Oil prices rising again today, as you saw, with Brent crude climbing above $100. The optimism introduced to markets yesterday by U.S. President Donald Trump has faded quickly as investors continue to monitor an escalating situation in the Middle East. So for more, let's bring in Jeremy Irwin, global crude lead at Energy Aspects. It's good to have you join us. Thanks for taking the time.
Yeah, thanks you.
So we're seeing WTI and Brent trading near 100 today, as I mentioned. Prices in places like Dubai and Oman, though, remain well above those levels. So what does that tell you about the market right now, and which one's currently pricing it more accurately?
Yeah, in our view, the East is probably pricing it more accurately. We think eventually that will spread into the other benchmarks like Brent and WTI. Just with the severity of the losses, the East is really feeling the pinch on lost supply first.
So they're feeling it first. So then do you consider like current Middle East benchmark prices of an indicator of possibly where the prices could go for North America as well?
Yeah, well, we would frame it in that the Eastern benchmarks are going to lead, namely Dubai, and we think Brent is going to follow. TI will lag both of those, but there's still upside risk to that. Because I think what we're seeing in the trade flow shift currently is that the East is starting to tap a lot of supplies in the West to backfill the lost supply. So inevitably, that's going to put a bid under WTI and Brent more so, and we're going to see those start to catch up to what we've seen in Dubai.
Given Iran's recent strikes on energy infrastructure in the Middle East, and based on your data, I'm wondering, like, how quickly can regional producers restore production if the war was to end sooner rather than later?
Yeah, well, we've seen a lot of shut-ins in the Middle East, right, with their inability to clear the supply. So the deeper those shut-ins get, the longer it's going to take to ramp up those supplies on the other side of this. Our current base case is that disruptions to shipments through Hormuz extend through the end of April. And so we would say production impacts are going to linger until at least June at this point in the Middle East. They will be lesser than what we're going to see probably in March and April, but they're going to linger for May and June in our view.
And you're saying there's certain countries that are best positioned to recover faster?
Yeah, that's correct. I would say probably the countries most impacted and will have a harder time ramping back up will be places like Iraq and Kuwait, just due to the nature of their fields and their high water cuts, whereas the UAE and Saudi is probably a quicker recovery on the other side of this.
It's been interesting to watch like the deterioration of the oil market ever since this conflict kind of started. I mean, the market has consistently underestimated the risk of the Strait of Hormuz being closed, yet this scenario has actually happened. So in your view, why were producers not better prepared for something like this, just in case it was to ever happen?
Yeah, I think it's definitely an unknown and it's an uncertainty. So how do you really, decide on a capital budget on an unknown situation? I think we're going to see a response from producers globally, but just it cannot backfill the magnitude of supplies lost. So that's probably how I would frame it.
Yeah, because it is an area that was known for geopolitical contention, right? So it's interesting that producers, I guess, were not better prepared for this maybe happening. In your view, do you think there will ever be a return to normal when it comes to oil prices after this conflict is resolved?
Well, I think we see a structurally higher floor for oil probably in the 70s and 80s after this conflict's resolved, namely because you're going to see inventories drawn down globally, and you're going to see a bid from countries looking to refill their SPRs and secure their certainty of future supply. And that goes on top of what we've seen in global balances, where we went into this year forecasting about 2 million barrels a day of surplus. And now we've had the Kazakhstan losses in Q1, followed by Venezuelan blockades. You had freeze-offs in the States. Now you've had the magnitude of Middle Eastern losses. So that's really tightened our global balance to essentially flat for the year. So it's been a big change to the fundamentals.
You do have a chart showing Iranian crude at sea. Despite the U.S. sanctions waiver that's happening right now, you say it'll be difficult for these barrels to actually find buyers outside of China. Why is that?
Yeah, it's mostly a banking thing. We just think there's going to be a lot of banks that are hesitant to facilitate that type of transaction. Now, we have heard some buyers in India have found ways around that and are pulling some Iranian barrels, that were on the water. And in general, we see the excess of supply in Iranian crude on water, Russian crude on water will be used as a short-term type of bridge in supply. But there's still going to be a lot of hesitation from the pool of buyers that would touch Iranian barrels, mostly due to banks being reluctant to facilitate that transaction.
How does Russia factor into any of that, or does it, I mean, in your view? Because we saw today Russia is boosting its oil revenue to a 4-year high as prices for Russian oil is surging. Are you factoring in that Iranian crude now also competes with Russian barrels as well?
Well, we've seen the discounts on both Russian and Iranian really evaporate and now even trading at premiums. So I think that just speaks to the demand for prompt supply in the East. If you have a cargo that's on the water and that can deliver within a week or two, there's a lot of demand for that because the run cuts we're seeing in Asia are not economic. They're being driven by a lack of crude supply. So as you get waivers and that opens up more potential barrels you couldn't touch previously, you're seeing demand for those barrels. But it's probably focused to a smaller pool for the Iranian buyers as opposed to the Russian buyers who I think would have a broader pool of potential refineries that would be looking to purchase it.
Interesting. Okay, we'll leave it there. Jeremy Irwin, global crude lead at Energy Aspects. Appreciate you joining us. Thanks so much.
Of course. Thank you.